Hey, welcome to Transition Thursday. And this week, I wanted to talk about inventory because inventory is such a big part of a lot of transactions that I'm involved with. In fact, almost all transactions that involve inventory are going to have some challenges along the way, particularly in the private company space. So what I wanted to do today was to start with three case studies or very quick examples of some things that can go really wrong in a transaction where you have inventory. And that could be a distributor, a manufacturer, a retailer, even a technology business that has work in process inventory. How that inventory, those new products are accounted for can make a big difference as you go through a transaction, and as you'll hear, even after a transaction. So the first case was a client that told us time and again as we were starting into a process, a transition process, that his inventory was perfect. That they did cycle counts every month throughout the factory, throughout the warehouses, and they knew exactly how much inventory they had, regardless of the fact that they hadn't done a full count in 4 years and that they had notice to reader or compiled statements. Well, as you can imagine, they missed inventory by about $1 million at the time that the transaction closed. So it's important to know that when you sell your business, at the closing, the owner now has control of the situation. They are the ones that produce the closing balance sheet. So they're the ones that go in and count the inventory, count accounts receivable and payables and all that sort of thing. So they're the ones that will give you the final number at closing. So when you miss by $1 million, you're going to get a claim for $1 million reduction in your purchase price. And that's normally the way share purchase or asset purchases are drafted. The second client was a little bit different, but they told us at the start of the transition that they felt that the inventory was probably about $2 million lighter than what they were showing on their books. And they weren't really inclined to go and do a full count because their inventory was factored or used as security for bank loans for the company. So they had factored both their inventory and their accounts receivable. So they were quite reluctant to go and do a full count because they knew that would mean less financing available from their lenders, even though the company was otherwise quite successful. Well, as it turned out, they were actually $4 million light on inventory, and they had a very difficult fight after the transaction. Lots of accounting fees and legal fees. It went through arbitration, etc. And that's not what you want when you've sold your business. You want to be able to move on with your life, with whatever you want to do after transaction. You don't want a year of fighting over how much inventory was there or wasn't there. Now the third case was different again. That's why I wanted to have the three examples, because in the third case, when we first visited with them and we went through their warehouse, it just seemed to me, and I've been to warehouses and factories all over the world, in Asia, across Asia, in Europe, in North America, etc. And it just seemed to me that the inventory was much greater in this particular warehouse than what the financial statements were showing. And it wasn't an industry that I knew particularly well. It was just a sense I had that it seemed quite light. So we actually convinced the client to do an audit procedure over inventory only. So the client hired an accounting firm. They came in and did a full audit just of the inventory of the business. And lo and behold, it was $9 million higher than what they were showing on the books. So normally we see inventory for private companies being lower than what is shown on the books. In this case, the inventory was $9 million higher. And what that means is they were showing more inventory going out the door in their financial statements. So they were showing less profits than what they actually had. But there was no way of knowing when those profits occurred. Was it just last year? Was it 2 years? Was it over 5 years? Etc. And so the transaction ultimately collapsed because it reflected not only on inventory but on all the financial controls in the business. The client restated their financial statements. They had very, very large tax bill, lots of other challenges for them. And then fast forward 2 years later, we were again retained to start into a process, and once again they missed by a significant amount, and they decided to postpone going to market. So this has delayed this particular client's, this particular business owner's transition by many years beyond what he was originally expecting. So why does inventory matter so much? Number one, it matters in manufacturing, distribution, and retail because a buyer is counting on that inventory being good and saleable condition because that's what's going to generate future cash flows. It's also going to help a buyer to finance the transaction because inventory and accounts receivable are two major assets, working capital assets that are used to finance transactions. The other thing is, I've mentioned, missing on an item that's as important as inventory reflects really poorly on the financial controls you have in the business, and that can have an impact on how a client views or a buyer views your business. Remember my discussion a couple weeks ago when I talked about the coffee stains on tray tables. This is one of those issues. This is a broken tray table. This is not a coffee stain. These are broken tray tables on the airplane. So it's very important. And thirdly, as I mentioned before, it can lead to post-closing fights over the working capital that's left in the business. And if you're lower than what you say, it's very likely that the buyer is going to want a dollar for dollar adjustment to the purchase price for every dollar that your working capital is below what you've said it's going to be. So that's some really important considerations for anybody thinking about a transition, and more reasons why I believe having audits of your inventory or having really good controls over your inventory is critically important to a successful and smooth transition. Next week I'm going to talk about excess inventory because I hear this a lot from private company owners that say they have lots of excess inventory and they want to have a better value for their business because of that. But I won't go into that detail now. But I would like you to share this today's Transition Thursday with other business owners if you think this message resonates or would resonate with them, and really put some of these thoughts into action. Share your comments below as well. Appreciate that. I love seeing comments. I will do my best to respond to all comments that I receive. And have a great rest of the week, and I will see you next week. Thank you.